Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with a very special guest. It's one of the younger guys in the resource sector, but he's already built up a really, really big reputation. He's known for doing big things, has the top performing fund in the entire sector. In fact, if you talk to anybody, whether it's legendary investors like Rick Rule or Doug Casey, or some of the big mining giants out there, like Keith Neumeier, like Amir Adnani, those guys will tell you Marin Katusa is a one-of-a-kind guy. And he really has been the most disciplined stock picker. And that's not my words. That's actually Doug Casey himself saying Marin is the most disciplined stock picker in the world. He runs KatusaResearch.com. It's an absolute must, guys. This is a no-brainer. You just go to the website, subscribe, it's free. KatusaResearch.com. You've got hedge funds from around the world, billionaires from around the world. They want to know what this guy's talking about, what he's researching. He's actually going to talk to us today about a new strategy he's using that he just disclosed to some of the partners in his funds last night. And here we are talking to him today. Marin, thank you so much for joining us.
Always a pleasure, Dan, talking to you. Hey,
Marin, really looking forward to this interview. We've had a major sea change, at least here in the near term for 2016. Is this a bear market trap or birth of a new bull market for the junior shares, specifically with the precious metals?
Great question, and nobody really knows the answer, but I'll tell you what I believe and where I'm placing my money. First of all, the volatility that I've seen in this sector, the resources, or even the general markets, I've never seen before in 15 years. We've talked about this in the past, but Dan, people have to understand how fast and vicious the money is flowing around. It's not just the Fed from the U.S. or big hedge funds coming in or out or blowing up. You got to also consider what I call dragon economics, the Chinese effect. Not only does China have a lot of money, but their people have a lot of money, and they're looking to get it out of mainland China. Remember, China is a communist country, so they think differently than us, the governments. And for example, I'm just writing an article right now. A lot of people don't realize that in one day in April, more cotton was traded in one day in the Shanghai markets than the whole year previously. That's insane. It would be enough to put a pair of pants on every person on the planet in one day. There's not even enough cotton for that. In one day, enough soybean traded for 52 billion servings of soy. So every person on the planet would have 8 servings of soy in a day. We're talking about insane speculation that the Chinese money is fueling. You look at my hometown of Vancouver, crack houses, things that you would walk by and just shake your head on the street going, how could someone allow their house to look like that, are selling for $2-3 million on a 33-foot lot. We're talking like, 1,200 square foot houses, duplexes for $1.5 million because the Chinese money is flying in. So it's fleeing for safety. Remember, the Shanghai markets put new foreign taxes on the Chinese money, and the Chinese money is desperately fleeing. Go to Sydney, go to Toronto, go to London, go to Vancouver, and you'll see these effects. But it moves very quickly. And then you look at the shadow banking sector in China. So there's a lot of unknowns here. So to come back to your question, is this a trap, a bear trap, or the beginning of a bull market? I don't know the answer, but I'll tell you what the best way, the most logical, the most prudent, the most disciplined way is to look. You could have thrown darts in the resource sector and you would have doubled your money. Like if you look back to what we've said a year ago, 6 months ago, 2 years ago, you want to stick with the best in the business. So make sure you take your profits on what you would call your slippery speculations or things that have worked out. But management, like if a president's not owning a bunch of stock, you might want to get out of that stock now. And that's what I've done. I've now reduced my fund's positions in all but my 5 core positions. And I've sold a lot of great stocks with great management teams, but what I'm doing is I'm going long and strong on 5 core positions that I believe are going to go up 4, 5, 10 times from here, because the variables, what make a great company, are all in place. And it's just a matter of time before it goes. And, you talked about Amir and what we've done with BRI. I wrote another 7-digit check on it just a few months ago, and it's one of the top performing gold stocks in the resource sector. Why? It's not because I'm talking about it. It's not because you're talking about it. It's because it's the real deal. And when you compare it to any one of the other gold banks or, the big plays, it's not only the most undervalued, but it has the most upside. And there's a reason why Amir and his management team are buying in every financing and buying hands over fist, and they still own 10%. So when you look at a lot of people don't even know what this metric is. And I remember my background's math, and I've got a whole team of geologists and engineers that work for me. But a lot of people think, I'm going to buy gold because the Fed is going to print dollars and they're going to go down. Okay, that is true. But what a lot of people, Dan, don't think about is, what about the dilution these gold companies give me? Everything fundamentally comes down to, you are a shareholder of this company. So what is your value per share? Now, if a company grows their gold resources by 4 or 5 times, but dilutes their shareholders by 6 times, you actually own less of the company than before. And if you look at the Warren Buffett and the most successful guys in the business, what you want is a business that grows in value for your share. So I invented a formula called the gold growth per share, GGPS. That's the type of stuff you want to look at. Is your company growing your value? Just like a company wants to grow their resource, you want to go from 1 million ounces to 2 million ounces. As a shareholder, why would you not want your share exposure to be growing? It's a very simple complex, but people don't think of it that way. So if you look at it, when you line BRI, Brazil Resources, Amir's company, that we're a major shareholder of, and I'm very proud to say that, and I've been for, 6 years now, it is the number 1 stock in the whole sector on a GGPS perspective, on a gold growth per share. No other company comes close to it. So here's my question. Why would I own something else that has half the GGPS? It's like an earnings per share. You want to have the best metrics possible. Then you look at the management team. It's one of many variables, but that's why I've bought even more BRI. And you'll see the biggest funds in the industry do the same thing. This is very early days.
Yeah, no, I was actually shocked. I spoke to Doug Casey about 3 weeks ago, and Doug, who never discloses what he owns, what he's buying, he's always very general. And, if you want, you can get his newsletter and go that route. But, he's very, very general. And, man, he came right out of the gate. He's like, I am going big into BRI, which is Brazil Resources. On the TSX Ventures, BRI, and on the OTC is BRIZF. But he was very, very aggressive, and I've never heard Doug like that. And by the way, that was when the stock, I want to say, was about, my goodness, it was probably maybe 75 cents to $1. Today it trades for over $1.50 on the Canadian side. Marin, you said that you had a new strategy you were sharing with your fund managers. Is this the gold per share strategy, or is this something different?
Well, the gold growth per share is just one of the many strategies that I've announced to my shareholders in the fund, which I am the largest shareholder myself. Doug Casey is the second largest shareholder. If you think about just Doug and I, we own a little over 40% of our own fund. We're the largest fund in the resource sector here in the west coast of Canada. In the hub, Vancouver's kind of where all the action is, So there's not a deal that I don't see, Dan. And what I'm telling everybody to do is look at, you don't need to own 20 stocks. What you want to own is the best torqued companies, the companies with the best management teams, with the best upside, that are currently being undervalued, because in this hot market, people are funding everything and anything again. The cockroaches are back out. Guys that I haven't seen in 5 years are now calling me up going, hey, Marin, do you remember me? And I'm like, unfortunately, I do remember you, and that's why I won't do business with you. So that's what I'm trying to get at here, is every piece of crap is getting financed again, and people are feeding the zombies. So what I am trying to explain to people is narrow down your portfolio. Everyone talks about you need a basket, you need to be diversified. I actually don't believe you need to be. What I'm saying is if you do your homework, you bet on the absolute best. And that's what Warren Buffett says. It's exactly the same strategy. Bet on the best. I don't need 8 quarterbacks to win the Super Bowl. I just need the best quarterback, the best linebackers, the best running back, and the best wide receiver. And that's what I'm doing for my portfolio.
Marin, oftentimes when sectors have big runs like this, people start to look at the portions of the sector that might not have had a big run in this huge, basically gain we've seen in 2016. Uranium comes to mind. It was the first to enter the bear market, and it's still struggling. What are your current thoughts on this sector? I know in the past you've talked about Amir's other company, Uranium Energy Corp. I was looking at the company the other day, and I mean their Hobson facility, which I want to say is one of the only 4 processing facilities for uranium for publicly traded companies that people have availability to. And I mean the thing's got to be worth at least $75 to $100 million, and currently UEC's market cap is less than $100 million. I mean, is Uranium Energy Corp in the uranium sector? Is it time for this sector yet to rise as well?
I think with enough time, but you see, uranium's a victim of what I call the emerging markets and the FX, the foreign currency. So if you look at Kazakhstan, which is the world's largest producer of uranium, their currency has been devalued by so much that even though the price of uranium has essentially stayed the same here, their costs have been decreased significantly because they sell in US dollars. Right? So it's an FX advantage that they have. So they've been puking out uranium at a higher margin because of their currency advantage. Secondly, the Fukushima reactors are coming on slower than people expected, so there's that overhang of the U308 that has to work through its market. Then you got the Chinese that are looking and going now and buying directly from the mines in Africa. The Russians are doing strategic investments. Then what are the Americans doing? Rather than positioning themselves for the future, Obama's strategy was to sell double the amount of uranium of the DOE, the Department of Energy's stockpiles, into the markets to fund historic cleanups that have nothing to do with the current producers. So you've had all of the stars line up for what will make a bull market. So what have I done? Again, I have bought another 1 million shares of UEC alongside Morgan Stanley. Rick Rule's fund bought the same amount. We've all kind of, and we wanted more, but Amir didn't want to dilute his company, and we all participated in the financing. So what I'm trying to get at now here is, okay, what is going on in the North American markets? Well, the producers, there's only a handful of producers, they're trying to satisfy these bankers and these analysts and tell their shareholders, look, we did what we said we would do. We would go and produce. But then what is the point of depleting your reserves when there's no true cash flow per share to the shareholders? So what you're actually doing is diluting the shareholder because that value as a shareholder is worth less tomorrow than it is today. And that's another metric that I try to explain to my fund shareholders is you have to think of yourself as an owner of this company. And every move that the management are doing, is my company going to be worth more tomorrow or less? And unfortunately for most of the market, what their strategy is, they're depleting their reserves, and their companies are going to be worth less and less every day moving forward. And that's why I'm so bullish on UEC, because what they're doing is doing the opposite. They're the contrarian in the market, saying this makes no sense, we're not going to do that. And hence why the fund managers and some of the biggest funds in the world are looking at it going, hey, we want to be part of this. And when you say, what will this end up? There's 3 cycles in the market. You got the boom, the bust, and the echo. And Amir will come and consolidate this whole U.S. sector in 3 to 5 years, and you'll see how this will all change back. So just like the gold market has taken off here and everyone's feeling great and every idiot is a genius now, well, I think you'll see that in the uranium markets. Probably not this year, and that's irrelevant to me, Dan. Like, you know, I go long and strong, and I can hold a position for 6, 10, 12 years. Some of my positions, look at BRI. We've been a shareholder for over 6 years, and I'm totally happy of adding more to the position because I don't need many stocks. I just need the best stocks.
Marin, inflation is the first thing that comes to mind when discussing negative interest rates. And I know you've been like the contrarian's contrarian. And I'm wondering if negative interest rates are actually more deflationary. I have to imagine that not having a yield gives savers and investors less money to spend into the economy, less money to reinvest in the markets. What are your thoughts on negative interest rates? Is this inflationary or this is deflationary? I know it sounds like a basic question, but everybody seems to be on one side of this. So I'm really curious what your thoughts are.
Well, whether it's luck or good analysis, I've been pretty spot on where this has all gone the last few years. This is where I think it's going to go. You nailed it within your own statement. Negative interest rates are going to dry up capital, hence, by definition, will be deflationary in most markets. However, within that general macro call, you will have pockets of insane inflation or bubbles. For example, where I see gold going. Gold is it's a preservation hedge. So if you're a family office, okay, and a lot of people don't understand this. Do you know that there's over 3,500 family offices in the U.S. that used to invest in hedge funds with a minimum assets under management of over $50 million? That's kind of the definition of a family office. You got to have $50 million. So Dan, your family will be there in a couple of years, but that's the definition of a family office. There's 3,500 family offices with at least $50 million or more that used to invest in hedge fund managers. But what happened with the hedge fund industry? Every slick, smart cat started to become a hedge fund manager, and they did not own their own shares. Less than 25% of the hedge fund managers actually own shares in their hedge fund. So what these family offices have figured out is, wait a second, these hedge fund managers actually aren't beating the market. They're diluting the family offices, and these hedge fund managers had to take massive punts, big risks. Why? Well, they're not shareholders, so for them to make real money, you either get a huge fund with billions and billions in assets under management, hell no. So now, why would you invest in a hedge fund with your main quarterback has no skin in the game, and he's going to take massive risks so he can make 20% on your money? Now, what happens now is the hedge funds are sitting there going, okay, we see that model doesn't work anymore. So they're trying to create their own strategies. And where do you put your money in a negative interest rate market? So what happens is people will start parking their money in gold to protect themselves from the negative interest rates. But people are also going into real estate because they're looking for that yield. So cap rates are going to be going down significantly, so that increases your risk. Remember, Dan, risk is directly associated to the price you pay for the asset, okay? Mm-hmm. So now you're going to see bubbles within the sector. We're not yet at the bubble for gold because we're in the early innings here, but it will come. It will happen. And these stocks that you're looking at that are, gone from 75 cents to $1.50, they're going to go to $15 because these family offices are going to look at these metrics, they're going to figure it out, and they want to be positioned in this. And then you got the Asian money, you've got the European money. There's a lot of money on the sidelines scratching their head trying to figure out what do we do. And more importantly, if you look at the demographics globally, the baby boomers have money, and they're looking at preserving their money. They're going to retire, they want to leave a little bit for their kids, and they want to enjoy their life. And everyone's going to live longer because of medical advancements. So what are they going to do? They're going to want to put their money in places that it will be safe. And gold is definitely one of those areas. And right now, gold takes such a small piece of that money looking for safety. If it just doubles think about this, for the amount of money that has entered the gold market today, if that percentage of global allocation, which is like right now 0.15%, if it just went to 0.3% of that baby boomers' money, the price of gold doesn't double. It's exponential. You're going to see $4,000 or $5,000 gold. And we're talking about 0.3%. Like, that's way, that's less than people's allocation in just one company, like Exxon or Apple. So this is early days. So I think it's going to be very deflationary, but because of that, there's going to be certain sectors that are going to be massive bubbles.
That's incredible, and I'm sure you're watching, or at least amused by the reports of Stanley Druckenmiller, all the significant buyer of gold. Let's see, Ray Dalio, significant buyer of gold, and then Carl Icahn. He's now more short than he's ever been, Marin.
And they're in the same situation. They're looking at it going, where do we put our money? Those are the type of people you want to listen to, and it's interesting, though. I also tell people not to underestimate human ingenuity. Remember, I talked about the innovations in the oil patch. So, be prudent and be smart, and don't jump on every trade. The worst thing in the world, I'm going to give you, a couple of tips here. Whenever you're feeling like, oh my God, I got to get into the story, relax, chill out. There's always a time. And just do your homework and look at the patterns. I always try to emphasize people. Mm-hmm. Are they growing your value per share? If this company's been diluting your value for the last 2 years, what pattern is going to change? Do they have a plush office in Vancouver? Now I got the advantage of I can go to their office and see, are they spending money on a fancy office, or are they doing all the right things that I want to see? So those are the type of questions you got to ask yourself. Or follow people that are doing the right type of work.
Marin, you've been very generous with your time. Just last final question. I just want to put you, the master, in the little guy's shoes right now in this sector. And you've already been very generous with the advice that people can take right now and implement in their own lives. You're such a clever guy. And, everybody I talk to, you've always got the edge. So let me put you kind of in a restrained situation and really see if we can get the edge for the little guy. So if you had, let's say, only $50,000 to invest in the junior resource sector, how would you position yourself to give yourself an edge?
Well, I would do exactly what I'm doing right now. Remember, Dan, I started with nothing. My father was not, from a royalty. He was an immigrant to Canada. We're a hardworking blue-collar family. We do the right things, and I started with very small assets. And what you do is do your research, do your homework, and don't try to think you're going to get rich overnight. That's the biggest mistake. So if you have 50 grand to invest, you're probably not accredited, which means you can't get into private placements. That is a problem, I think, with the markets, and I think it's insane that in the public markets, the exchange won't allow, let's say, a teacher who's probably more sophisticated than most of the rich people or stockbrokers in the industry, but they won't allow someone who's not accredited to participate in a private placement, but they'll allow, the peer-to-peer lending or crowdfunding, which I think is an absolute insane process. So right now, another strategy I'm staying away from is very early stage grassroots exploration, either privately or in the public markets. Why? Because the most torque, the most leverage are going to be in what I call like the Ross Beatty model, where he became a billionaire by buying assets that have had hundreds of millions of dollars of work from previous companies. He picks them up for a dime on the dollar. The markets move forward, and guess what? Those assets are now in the money again. So that's what I'm doing in these companies. And you look at, what Amir's done with his BRI. There's over $100 million worth of drilling and geological work that's gone into the ground on those projects, and he's picked them up for a dime on the dollar. That is smart business. They say buy low, sell high. Well, that's true, but it's very hard to do. And why would I pay $40-50 million for a geologist with a dream, some crayons, and an idea, and fund his idea when you look at it? I know a lot of smart geologists, and I've got a Canadian Hall of Famer works for me in my office, but a lot of geologists are not Hall of Famers. So be very careful of what you're funding. Where are your dollars going? Ask those questions. So for myself, in today's market, I would want to position myself with the best geologists, combined with the best businessmen, combined with the right financial structure. Are they growing my value per share every day, or are they diluting me? And sadly, Dan, 90% of the companies, if you just look at it from that standpoint, you won't have to spend much time on them any further.
Marin Katusa of Katusa Research. Really, truly a wealth of knowledge. So many reports already there waiting for you. But subscribe at katusaresearch.com. And really, everybody, this is one of those interviews that, in a week or two, you should probably pick it up and listen to it again, because Marin has made himself and essentially the people who follow him a fortune. You guys have a great day. Thank you again, Marin. I appreciate your time.
Always a pleasure, Dan. Take care.